Hey everyone, this week I'm going to focus on what's happening with inflation, the Fed, and interest rates. Now, back in early March, soon after the conflict in the Middle East started, Marcus and Millichap Research released a report focusing on how the military action could impact the US economy. And one of the things we highlighted was that if the conflict extended beyond 3 months, we'd start to see more significant repercussions in the US economy. Well, we just passed the 3-month threshold, and we're starting to see the impact. The price of oil is elevated, but it appears to be range-bound near $100, which is lower than originally expected. To mitigate some of the shortfall in oil deliveries caused by the conflict, the government has tapped into the strategic oil reserves. Prior to the Middle East conflict, there was about 415 million barrels of oil in the U.S. Strategic Reserve. By mid-May, the reserve was down to about 375 million barrels, and currently the U.S. is drawing about 10 million barrels of oil from the Strategic Reserve per week. That has helped keep oil prices range-bound, and nationally, the price of gas appears to be settling in at about $4.50 a gallon. Now, the price of gas does vary dramatically, ranging from around $4 per gallon in Texas and along the Gulf Coast up to the $6 range in California. Diesel fuel, which impacts trucking and distribution costs, is running in the $5.60 range. And elevated fuel prices are driving inflation higher. The Consumer Price Index has increased sharply, up about 140 basis points from February to 3.8% in April. Meanwhile, the Producer Price Index, which tracks wholesale prices for businesses, climbed 260 basis points since February to 6% as of the April reading. And finally, the Personal Consumption Expenditure Inflation metric, which is closely watched by the Federal Reserve, has pushed from 2.8% in February to the 4% range. All of those metrics are well above the Fed's 2% inflation target. And that inflationary pressure has reshaped the interest rate outlook. In February, Wall Street anticipated 1 or 2 Fed rate cuts this year. Now, expectations have shifted to a 50% likelihood of a Fed rate increase by year end. And that has materially changed the interest rate climate. Since late February, the 5-year Treasury has risen by about 60 basis points to the 4.2% range. And the 10-year Treasury is up by about 50 basis points to the 4.5% range. But we have to remember that the outlook is fluid. Kevin Warsh has just taken over as the chairman of the Federal Reserve, and although I think he would be hard-pressed to make a compelling argument for reducing rates at this point, I also think Warsh would be highly resistant to a rate increase. Of course, Chairman Warsh only has one of the 12 votes in the Federal Open Market Committee, so he can't dictate rate policy. Now, if a pathway to ending the Middle East conflict is found, a lot of the energy-driven inflation could begin to dissipate, and that could change the interest rate calculus. So, what's this mean for commercial real estate investors? The greatest headwind for commercial real estate investors is the rapid rise of interest rates. Deals that made sense 90 days ago may now be more challenging, and as a result, the bid-ask spread between buyers and sellers is beginning to widen. While the market had, in large part, begun to reach an equilibrium over the last year, the interest rate surge is making things more difficult. And although considerable capital continues to pursue commercial real estate assets, especially given its resistance to inflation and durability in economic down cycles, the interest rate volatility could weigh on transaction flow. Now, despite the short-term interest rate-driven headwinds, we have to remember a few things. First, commercial real estate space demand remains sound. Second, the new supply pipeline has continued to shrink. And third, average national rent growth across all property types is forecast to strengthen in 2026. So looking forward, commercial real estate supply and demand remains well positioned to navigate short-term headwinds while sustaining longer-term growth. And that's the key ingredient. When you look beyond the short-term headwinds, beyond the Middle East conflict and the resulting inflation and interest rate pressures, the supply and demand outlook for all types of commercial real estate remains favorable. And that's what investors need to focus on as they keep their eyes on the horizon.